Hello, welcome to this series on whether you are PE curious, designed to demystify the proposition and also the jargon around PE investment in law firms. I'm delighted to welcome a really great panel to this podcast today. I'll introduce them in a minute, but just to explain, we are going to be having a small series of these podcasts, 3 in total. We're going to be looking at the question of PE investment in law firms and specifically looking at some of the key jargon, some of the key terminology, and really get sort of under the bonnet of a PE investment in a law firm. So I would like to introduce you to this brilliant panel of experts that we've got joining us today. First of all, we've got Fred Bürger. He's from EY-Parthenon. He is a partner in the private equity value creation team. We've got his colleague, Mike Strotz, who's a director in the strategy and expansion team. And then I'm joined by my brilliant partners as well, Zulon, Begum and Nick Leale. Nick's a regulatory expert, and Zulon, like I'm one of the partners in the non-contentious partnership law team. So let's get straight on. I'm going to start off by asking you about, first of all, why we're talking about PE so much in legal services at the moment. I wonder, Fred, whether you could just briefly touch on what the benefits for law firms are.
Yeah, great. Hi, Corinne, and super pleased to be here. I think this is one of these things that's just a natural evolution. I think private equity is always looking for new investment opportunities, and I think in the law and legal space, I think what they see is quite a fragmented market. So I think they can definitely see an opportunity in playing a role in consolidate that market. And I think they use that through a number of different sectors in the past, like accountancy, consulting firms, etc. So I think it's one of these tried and tested investment hypotheses that they do. So I think that's why we hear a lot about it these days.
Thanks, Fred. And Mike, you look at it from an operational perspective, don't you? What are the benefits there?
Yeah, and maybe just to take a quick step back from that. I mean, when I think about what the priorities are for PE and why they would invest, right, and why someone would be interested in investment, PE, I think, fundamentally care about 3 things. They care about investment, they care about growth, and they care about return on investment. And so I think it's about how do they think about deploying their capital to improve businesses to then generate return on investment. I think there's various levers obviously that you can pull within an organization, and PE are incredibly good at finding those levers and improving organizations. And I think there's probably a whole series we could do just on the various levers, and I'm sure we'll unpick them as we get
Maybe
through
we will, right?
Yeah, exactly. So yes, I think it's the opportunity to deploy the way that PE think and the way that they invest, the way that they deploy investment. I think creates a significant opportunity for a law firm in this space.
Fantastic, thanks both. That's really interesting to set the scene as to what's driving this burst of interest in the market, particularly at the moment. I mean, I know, Zulon, we're going to come on to talk about process a little more in this series, but I wonder whether you could just at very high level, give us a very high level view of the outline of the legal process that we're talking about here, the steps that we might see if a PE firm wants to invest in a law firm.
Thanks, Corinne. Yeah, so I see it as being kind of the 4 core kind of process elements when you're doing a transaction like this involving external investment in law firms. So firstly, you would start off looking at your structure, whether you are currently the right structure or whether you might need to restructure in order to be attractive to a PE investor. So there are a lot of law firms who are LLPs. Some might still be general partnerships. Some might be limited companies. Now, if you're a general partnership, that's not going to work because a general partnership can't be an ABS, for example. And I have not heard of any PE firms investing in general partnerships. There have been investments into LLPs and companies. So you might be looking at those 2 legal structures if you're not already one or the other. The other thing you'd have to look at is obviously the regulatory wrapper around your legal structure. So you have to be an ABS in order to take external investment. So you may, as a law firm, might already have that, or you might seek to get ABS authorization in advance of any deal, or you might do it as part of that deal, and that would obviously need to be factored into the timetable of the process. The second stage will be, of course, due diligence. So both sides will be looking under the bonnet of each other. So from the investor's perspective, looking under the bonnet of the law firm that they're seeking to acquire. So looking at the key risk elements, so around claims histories, partner dispute issues, employee issues, looking at, and obviously doing the financial due diligence around, revenue, profitability, all of those things to ensure that the investment case actually stands up to scrutiny. Conversely, the law firm itself should also be doing some level of due diligence, and there are regulatory requirements around that, which Nick will talk about, to ensure that the PE investment that they're looking to partner up with is an appropriate firm to partner with. And then, of course, you move on to the transaction documents. So the typical kind of sell and purchase process. So you'll have an SPA. In a PE investment environment, you'll have other things like investment agreements, shareholders agreements, partner rollover terms. Often partners may move to employee status as well as being kind of shareholders or equity holders. So the partners will have employment contracts to look at, and other kind of incentive structures that might be behind the scenes as well. And then, of course, the regulatory approvals that I mentioned earlier. So if the firm is not already an ABS, it would have to convert to becoming an ABS. The PE investor itself would need to be approved as an owner and manager of the law firm. And that can be quite a complicated process because PE investments tend to have quite complex structures above them. And there are various requirements around what the SRA would look at in terms of who needs to be approved as an owner and manager of the law firm.
Fantastic. Thanks, Zulon. And I'm glad you mentioned the regulatory piece, because I know we're going to come back to that with Nick in this session and in the next one too. Brilliant. So obviously you talked there about incentives, Zulon, and I think that the kind of the compensation and reward package is going to be a really relevant consideration in any decision to go down that path. And I wondered whether we could just get a view from either Fred or Mike on that perspective in terms of how the kind of the selling, usually equity partners in the law firm, sometimes all the partners, of course, and also kind of the next generation of partners that might not necessarily be equity partners at the moment. How are they going to benefit in a structure where it's PE backed as opposed to a classic law firm structure that we might have seen in years gone by?
I think this is a super important part. Obviously, everybody thinks about what their compensation is. And I think it's also, if you're part of an all distributing partnership and go to a model under PE ownership, your compensation will change quite dramatically. Particularly, you will go from taking drawings or distributions or whatever you call it, and emptying the partnership pretty much completely every year, to a model where you take a salary and you get some equity in that structure. So the cash flow will be materially different. Obviously, you get an annual salary, but then you get the value of the equity only on exit. So when the PE fund and all the shareholders sell their equity, that's when you get the value of that, which should be a material part. Overall, the sum of all these components should obviously, in a PE, if it goes well, in a PE deal, should be greater than the sum of all the distributions and drawings you would have done otherwise. But I think private equity firms really think about this quite carefully, because for them it's absolutely key that people are really fairly and highly incentivized to drive performance of the business. So I know they spend a lot of time thinking about this before the deal, and as they put this structure in place, they tend to think of it in various partner personas. So the structure might look a little bit different if you're a very recent partner, first, second, third year partner, to if you're a partner who is about to retire or maybe a midlife partner. So they try and make sure that the structure is attractive to all these different partner personas when they put these things in place. But a super important topic, I think. Mike, over to you.
No, I was just going to add perhaps one point, which is that I think a really important consideration, and Corinne, you kind of implied it as well, right? Is the focus on the next generation as well, and how you can make sure that you hold back sufficient equity and incentive for the next generation, both within your organisation, but to be able to attract new laterals into your business and the proposition to them. So I think as well as a focus on the existing partners, is how do you think about your retention strategy and your attraction strategy for your next set of partners that you're thinking about as part of your overall growth journey. So just wanted to add that to I think Fred's well made points.
Thanks, Mike. And actually, one of the things we've observed in the transactions on which we've advised is that the management team of the law firm has a significant role in designing that balance between the equity, between the salary, sort of making sure that people's expectations are going to be met. How that works. I mean, it isn't a case in certainly in the transactions we've seen of kind of the PE house coming in and imposing their design upon firms. I'm sure that a distress scenario you might find that, but in the ordinary course, we're seeing a high degree of interaction and discussion, engagement, and liaison on that particular issue. I wonder, Zulon, whether you've got anything to add in terms of the dynamics there and the kind of that basic principle there, which is switching from effectively an income model. Everybody's used to the income model and the distribution model to a sort of a income plus capital growth model. How do you think partners are reacting to that?
It is quite a fundamental shift because, as you say, there's a prevalent remuneration model in professional services and law firms. Is what we call the naked in, naked out tenancy model, where you put your capital in the firm, and while you're a partner in the firm, you reap the benefits through full distribution year in, year out. And then when you leave, you just get your capital back. You don't get any kind of capital growth opportunity in that model, but you do get 100% of the income profits as you go through your partnership career. So you're switching from that model, which is still the prevalent model in the market, to the income and capital growth model, which is, on one hand, it provides an opportunity for much greater reward, but also a lot more risk because it is slightly speculative. So partners are having to take a slight kind of leap of faith that actually in 5 years, 10 years time, when the firm goes through a secondary or a third transaction, that they will be able to make good on that capital growth in medium and longer term.
That's really interesting. And I think that if you're talking about that next generation of partners, things like what you can tell the bank if you're trying to get a mortgage out, for example, what does your pay slip say? Those sorts of things are really important. But I also think that an interesting angle there is that often law firm partners overlook the fact that this is all profit dependent. There's a sense of this is my annual compensation, whereas there's a certainty that has gone with partnership profits that isn't guaranteed. So I think there's a few elements to that. Now, I want to, as I say, bust a bit of jargon, as we talked about, because there's a lot of new concepts here and terminology that we come across when we think about PE and legal services, or PE generally, but specifically now it's coming into the legal services marketplace. And I'm going to come to you, please, Fred or Mike, on responses, quick fire responses to these questions. We talk in a PE context about EBITDA. But it doesn't feel like EBITDA really fits in a law firm context. So I wondered if one of you would mind grappling with what that actually means and what law firms, how law firms are taking that value.
Maybe I'll take this one, Mike. EBITDA is obviously earnings before interest, tax, depreciation, and amortization, and it's a profit metric. Obviously, if you take all the cash out in a law firm or any professional partnership firm, you don't have a profit per se. But that EBITDA is generated by partners taking a salary rather than emptying the partnership every year. So that's how it's kind of artificially created a profit level in the partnership, which is then substituted with ownership of the shares in the firm instead.
And actually, that's been our experience too. We've tended to see people take the kind of the drawings, the monthly drawings piece of a law firm partner's compensation and sort of transpose that across to the salary in inverted commas element in our experience too. And I wondered, and this is the literally $1 million question, but what sort of multiples are we talking about in these law firm transactions at the moment?
Obviously, the multiple is what's applied to the EBITDA to get your overall value at the point of transaction. And I'd probably categorize it into roughly 3 different categories in terms of in terms of the multiple. There's things you can control, there's things you can't control, and there's probably something roughly in the middle. So and we could do a whole series on this, but I'll try and be reasonably quick. So on things that you can control are your fundamentals in your firms, your profitability, your growth, particularly your organic growth, and how much growth you're able to generate with your existing workforce. There's your quality of earnings, so things like your cash flow conversion, your repeatability of service, your client predictability or revenue predictability from sticky clients. Again, lots to unpack in there. There's the scalability. So how well are you set up from an organizational process, technology perspective to scale rapidly? And I think there's also a point around your talent agenda, particularly obviously in a professional services firm and law firm, your ability to attract, to hire, to retain talent, then also thinking about succession planning and how you're thinking about the next generation. All of these factors will come into your multiple. And then I think just the other one that's within your control that I definitely need to mention is around data and AI. So even if you haven't yet fully deployed your AI strategy, if you like, it's super important that you're at least thinking about how you're getting your data in such a place so that you can really meaningfully deploy AI. So that's largely in your control. What's less inside within your control are the typical multiples of the industry from past transactions, the macroeconomic, the cyclicality of your services. You've got limited control over those things. And then probably the bit that's somewhere in the middle is how much interest you can drum up in terms of how many bidders you're going to get through the process. So a bit of a long-winded answer, apologies, Corinne, but that's probably the way to think about the different factors that ultimately impact your multiple.
Yeah, fantastic. And I think it's such an important question that I forgive you, Mike, for not answering in a quick fire way. Well done. I mean, another $1 million question is the kind of the proportion, as in the kind of the upfront consideration versus kind of the long-term securities, the portion that's represented by investment in the structure. As I say, my take on that is that it tends to be your monthly drawings is the salary part and the rest is equities. Would you say that that's reflective of your experience too? Mike, I see you nodding. Is that reflective of what you're finding too?
Yeah, I think it's on a case by case basis. That's a terrible answer, but I think it's one that has to be worked through very, very carefully. I don't know, Freddie, if you have a more refined answer than that.
I think it's an interesting topic. That might have been the case because it's something it's quite easy for people to get used to. Is what they normally got paid monthly. I think what we see with more and more of these type of structures coming in place, it's also a relative comparison. Obviously, what competitors with a similar structure pay, how much you pay in salary versus how much is a deferred consideration in terms of shares on exit, etc. So I think that dynamic comes into play a little bit more these days than maybe it did a couple of years ago.
Yeah, that's interesting. Thank you. And last bit of jargon that I'd like just to pick up is we hear people talk about sweet equity a lot. I wonder whether one of you might be able to just pick up on that and sort of just explain to people listening in what people are talking about when they're talking about sweet equity in this sort of a context.
Yeah, I mean that is the equity that's given from the private equity house to the partners, and there's a whole that is probably a session in itself of various structures, etc., and various classes of shares. But it's a class of shares that is given through to the partners from the PE.
I see. So it's sweet because it's a gift rather than you've purchased it. That's very, very clever. Thank you. Just briefly, Zulon, do partners welcome this sort of thing?
Well, again, it really depends on the firm, and it really depends on the leadership of that firm as well, because it is a leap of faith and a real test of leadership and trust in leadership as to whether you can get a transaction like this through. Obviously, if you're a smaller firm, very much kind of owner managed, and a small group of partners, it is much easier to manage. But if you're a much medium-sized, large firms with 50 plus and over partners, there's quite a few partners to carol into one single direction, and you need very strong leadership, clear-sighted, strategic idea of where you want to go to, and why PE is the way is the answer to the question about actually what the law firm wants to achieve. And if you can answer those questions to your partners, then yes, of course, partners will welcome it. But if you can't, you can cause, ructions within a partnership. So managing that kind of partner hearts and minds process is, sometimes kind of half the challenge.
I bet, yeah, absolutely, and that's so slick as well, Zulon, because we're going to come back to sort of consensus building in our second episode. So thank you for trailing that. Brilliant. And before we sign off, Nick, I wanted to come to you, please, because Zulon talked before about the regulatory aspects, which are obviously absolutely essential in any law firm business. And I wondered whether you could just run us through what the SRA, the Solicitors Regulation Authority, the Legal Services Regulator, needs to know. When do they need to know it? Can they stop PE for investing in law firms? It'd be great to get your insights, please.
Yeah, sure. I mean, there's quite a lot they do need to know. And of course, they can say no, although the issues tend to occur when the business just hasn't put together the information in the way that the SRA require, or not considered properly who the owners and managers of the business might be, and who therefore needs proper information in relation to their character before applications are made to the SRA. But in a nutshell, the SRA needs to know who all the owners and managers of the business is going to be. Obviously, that's more about individuals if there's already an ABS in place, but more complicated if there needs to be a new ABS formed as a result of the PE investment. And managers are very clearly defined by the SRA, basically members of LLPs, directors of companies if there's a body corporate. Owners, slightly more complicated because you've got to look at material interest and genuine influence, strategic influence over the business itself. But ultimately, what the SRA wants to know is that the owners and managers and the structure of the business is such that everybody understands their regulatory duties and won't do anything that causes or contributes to a breach by the body or anyone within it of the regulatory arrangements that the SRA expect to have in place. And as I said, with regards to individuals and their approvals, that's largely about, assuming you're talking about somebody who's not on the roll of solicitors, that's largely about showing very clearly someone's good character, likely to involve DBS checks if they're not with another regulator. And you have to remember, of course, the time it takes. The SRA are entitled to up to 90 days to approve individuals. And all of them need to be in place, and all of the information needs to be in place before that time starts ticking. And all of the information for the managers and owners, as soon as that's been worked out exactly who they are, including parent undertakings, of course, that has to be considered as well, and the ownership structures within them. All of that information needs to be in place before they consider the clock to be ticking. Of course, it's more complicated if you're dealing with the actual creation of an alternative business structure, an ABS, for the business as a whole, because there'll be the SRA are keen to say that they will look at the global management team in assessing whether they're satisfied that the business will comply with the regulatory obligations, but they want to know whether the required level of qualifying insurance is in place, for example, whether the COLP and COFA positions have got suitable people proposed for them. As well as that, they may be keen to know what the business plan is, so that there is within that a demonstration of genuine awareness and understanding of what managerial roles and ownership roles are in such a licensed body. And they tend to look at it all in the context of the business model itself. They might look at how businesses are connected, how separate businesses interact, how confidentiality is dealt with, referral arrangements, all those kind of things. And that can also be a lengthy process. They can extend up to 9 months for those approvals to be granted. So hopefully that's a briefish summary of the importance of it and what has to be covered.
Yeah, really helpful. Thank you, Nick. And I think you're right to point out the scope for delay, which is a practical experience that a number of people we've dealt with have found in their interactions here. And what I think is particularly interesting in this particular example is that it's so at odds with the way that PE wants to operate. PE is quite different from legal services in the sense that there is a real pace that we haven't necessarily seen in our sector. And this kind of regulatory process is about as slow as anything gets in legal services. I think the SRA would be the first to accept that too. So it's right from the get-go. You get a really interesting example of how PE and legal services are different and how they have to come together to make the deal a success effectively. Great. Thank you all very much for your insights there. Really, really interesting. And we look forward to our listeners joining us again for the other 2 episodes in this series. Next time round, we'll be looking at what the expectations are for PE investment. And then in the third part of the series, we'll be thinking about how to get PE investment ready. So please do come back and join us. In the meantime, if you've got any questions or comments, please do feel free to reach out to any one of us at either EY or CM Murray. Thanks again.